Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How is everybody doing? Hope you are doing well. Andrew Kuhn, Focused Compounding Podcast. Geoff Gannon, Focused Compounding Podcast. How's it going over there?
It's going very well, Andrew. How is it going with you?
It is going fantastic. So you know what we haven't talked about in a long time?
Yes, I do.
Volatility.
Volatility, okay.
And the reason I think it's like our third episode.
Yeah.
And the only reason I know, so on the Spotify app, you could sort it by like oldest to new or newest to old.
So some people go from the beginning?
So I did that, and it was too cringeworthy to listen to.
All right.
But I listened to our volatility one, actually. Great. And I think when we first started the podcast, like 2 years ago or a year and a half, whatever it was, there was a lot of volatility going on. Right. So we thought it would be actionable to talk about. And not that I think there's a lot of volatility going on now, because I think we're only past couple of days have just been whatever. I mean, relative to how much we're up, it's like nothing. But I think it'd be good to talk about how volatility could be your friend, and how you can, like, I guess, use it to your advantage and sort of keep your mental toolkit in check, and be able just to look for good companies. But before I do that, if you do like the work we're doing here, you want to also follow us on YouTube. Go to youtube.com and type in Focus Compounding, and you'll see my face.
Yes.
You'll see my face. And be able to be sure to subscribe there. We're going to be doing lots of content on there, and we're probably going to do a value investing course as well. So, and that will be for free. People charge thousands of dollars for that, but we're going to do it for free.
Yep. There's already videos about mental models up there that you're talking about. Yep. There's already stuff there for people to see.
Yeah. So be sure to subscribe to that. What's our business model? Good faith. We put out good content, and we hope that people subscribe and support us, right?
That's true, yeah.
So there you go. So talking about volatility, I guess the market has been, at the time we're recording this, it's not like it's down a lot or whatever, but I guess we've had a couple red days, and people on Twitter have been going crazy about it and whatever. But how do you typically think about volatility, I guess, in the market, and I guess when it comes to the portfolio?
Volatility.
You don't, right? No.
No, I do think about volatility, and that volatility is good.
Yes.
We want volatility.
Yeah.
That makes it possible for me to do my job. Buying stocks at the right price. And it's not possible when there isn't volatility. When the prices are moving around, I get the option to buy stocks at prices that I like. The few businesses that I like at the right price. So generally, with what I'm doing with managed accounts, we're looking for, the kinds of businesses that someone like Warren Buffett would buy, in the sense that they're predictable enough they can predict out earnings quite a few years, maybe 10 years or something. But we're only buying them at sort of, value investor type prices. Yeah. So, we're not paying 30 times earnings for a Coke, but we're paying, less than 15 times earnings, sometimes less than 10 times earnings for companies that you haven't heard of, but that we think have, moats and things like that. Sure. Well, because of that, without volatility, I'm just looking at stocks that are 20 or 30 times earnings, and they're never getting down to the lower level that we'd be wanting to buy them. So I always have a future return in mind, in terms of what I think it will return over if held for a long time. Usually I use like 10 years as a guess about that. We would sell before 10 years in most cases, but that's how you decide, more so than an intrinsic value in mind. I'm thinking, okay, this will return 9% a year or 12% or whatever. And the big variable there for a predictable company, for other companies it might be different, but the big variable for a predictable company is price. Sure. So the expected return that you have really depends on volatility. That's the only thing that's causing it to change. Otherwise, day after day, you're looking at something that you're expected to return 7% a year. And until prices drop, it's not going to become 10% a year. You're not going to be able to buy it.
Sure.
Yeah.
And that's why you have a watch list, right? Yep. A batting order, if you will, of all the companies that you like, where if they do drop a significant amount, it comes up on your radar more, and then maybe you're more inclined to, purchase it. Yeah. And to some extent, actually, that's why I've been pushing myself, kind of forcing myself to try to get the portfolio to be about half foreign and half domestic. Really? A lot of people have questions about that, about why would you do that? Is there any reason for doing that and stuff? Is this a diversification purpose? No, it's really just
widening the amount of opportunities. And it's not so much because there aren't enough stocks in the U.S. The danger is that too many of them move together. So it's not too many of them moving together from like a perspective of the returns, that of the volatility once you own it. So of like the beta and stuff that we'd be talking about of the portfolio. What it really is okay, so sometimes when things are going great in the U.S. stock market, maybe people are concerned about Brexit. Mm-hmm. Okay, maybe currency things in some country are causing some concern or something. There might be the kind of company we want, the kind of business we want that's available at a low enough price because of something country specific, right? So sometimes it's like industry specific and sometimes it's country specific, but usually something has to be happening wherever that company is in that industry, in that country, or in the world, which happens once in a while, for you to get a business that you think is great, because a lot of people generally would share your view about that, at a good price.
Sure.
And so volatility is what you need for that. So honestly, that's why we kind of expand that to looking at foreign countries as much as possible, is because there has been the difficulty of too many U.S. stocks not experiencing enough volatility. And so looking in other places for things that might be cheap enough because of things that might happen in just one country that doesn't really affect the U.S. that much.
Are you pretty agnostic towards what other countries on where you'd want to look for ideas, or is it pretty much anywhere?
Generally, yeah, it could be anywhere.
How do you come
the
across
right company and the right management?
How do you come across? And I think I know this, but people may be thinking of this. How do you come across like foreign, companies on screens? For example, like Guru Focus. A lot of times, if you come across a foreign company, like it's kind of like behind a paywall, or even other screens as well. Like, how do you typically come across that?
I don't really screen for foreign stocks. I mean, unless I have something that's specific to that country. There's one that I know that's good for the UK or something. I think there are some screeners people use for Japan and places like that. In general, I don't find screening worldwide to be useful. The quality of the data is pretty bad. Lots of things about the companies are pretty bad. The descriptions of it and stuff. There's sometimes language things. There's all sorts of weird stuff that causes a low quality in terms of screeners versus the U.S. The U.S. is pretty good for screeners. Other countries generally not, although, like I said, UK is fine. No problem with the UK. And there probably are screeners from some other countries I don't know well, like Canada or something. For really small markets, you can just, you just look at almost everything they have. If something was happening in Ireland, I can look at every stock that trades in Ireland.
Sure.
It doesn't take that long.
Yeah. So you're saying like if there's like a macro thing that's going on?
Yeah.
Got it.
Well, I've looked more at things in the UK because of Brexit. It hasn't changed as much as you might expect. I bought Japanese netnets after the tsunami. So there is sometimes something that draws your attention to it. I mean, I looked through all sorts of Greek stocks, didn't buy any when they had their debt crisis quite a few years ago.
Why do you think people use volatility as like a measure for risk?
Because it's how they experience it. This is a complicated one, but it's very weird, actually. But Buffett talked a little bit about this at the, I think it was the annual meeting. It might have been one of the interviews, but I think it was the annual meeting where he was asked about private equity.
Yeah.
And one of the things that was mentioned was, they don't have to market the same way. There's a greater chance that people aren't feeling the volatility in a private equity investment to the same extent that they are in a stock that's quoted daily.
Sure.
And that's a huge thing. And, I've pointed that out with timberland, for instance. There's a big thing where, so you can buy timberland outright. You can just own timberland. You can also own timberland in certain funds that own timberland and manage it and stuff like that. You can also buy like timberland ETFs or specific timber companies, public companies. Now, really, if you're thinking rationally about it, it should not matter to you what the structure is. It just should matter what the after-tax returns that you're getting and the actual asset are over time. So if you're buying the same land, either through a publicly traded stock or you're buying it individually yourself, except for the tax consequences and things like that of it, it shouldn't matter. But the truth is it does matter. Less liquid timber companies, timber stocks, often trade at a discount to more liquid ones, which doesn't make a great deal of sense.
Yeah, why is that?
Well, why I'd say it doesn't make sense. That's just true in general for stocks, right?
Sure,
so a lot of liquid stocks trade at discounts. In countless examples of the stocks that we own, they are the least liquid version of whatever stock that is. So we own in that industry or whatever in the U.S., we own the public company in that industry that's the least liquid. All the others are more liquid. That tends to be the case.
Sure.
But the weird thing about it is you're investing in something, a stock that's less liquid or more liquid, and yet you would comfortably own the timberland itself, which is a less liquid investment. It might take So, for instance, a timber stock that's pretty illiquid might take an individual with a ton of money and stuff 6 to 18 days, let's say, 6 to 18 days to get in or out of it, right? And I'm picking 16 to 18 days for a good reason, which is that, in general, actually selling timberland is going to take you more like 6 to 18 months if you owned it, right? Yeah. But I'm saying that logically, it will be at least 30 times faster that you can get in and out of the stock, and yet you're concerned about that, whereas you would be okay holding the underlying asset. And you see that a bunch I saw that even with some things where there were some publicly traded things that would buy houses and stuff. And people, and some that were more liquid than others, the stocks people would buy into. But of course, people aren't bothered by the fact that their home is an incredibly illiquid investment. I've known people that's taken months and months to sell their house. And yet it doesn't bother them.
Why is that? I mean, it's a psychological side of investing,
They're not
right?
getting a quote.
Yeah. I mean, what do they say? Liquidity makes people act kind of weird. I mean, like, I guess irrational, if you will, in some situations. But it's true, though. Yeah.
If your bank went out and got 12 offers for your house every month, and then along with your mortgage, they sent you an estimate of your price and how much it changed from last month, people would would honestly feel differently about the asset.
No, totally. Yeah,
they would feel differently.
It's a great way of putting it. I mean,
they would say I was down 3% in January, and start to worry about what that means.
Yeah, it's interesting though. It's kind of like when Buffett, I think last year he said nobody buys a farm because they think it's going to rain more next year, right?
Yeah, but that the volatility to a large extent is like the movement that you're seeing in the price, right? So when the more you check it, the more that becomes an issue. Yeah. And then there's actually, there was some, I forget the exact details of it, but there was a experiment that they did with showing people different amounts of, not different amounts, the same records, but just different intervals of how frequently they updated stock price history for them. And so if you did a stock price history where you showed this is what the stock market looked like over the last 100 years, and you showed people like daily or monthly returns, then then if you ask them, well, how much do you want to put in stocks and how much in bonds? They're going to say a lot less in stocks, a lot more in bonds. But if you say, okay, now I'm going to show you what it was each of 10 years for the last 100 years, then they're like, oh, stocks. Because very rarely did the 10 years turn out badly.
Sure.
But, probably 2 out of 3, 3 out of 4, whatever. I mean, the reverse of that, 1 out of 3 or so, of many of the shorter periods turned out badly. I'm sure that there were tons of examples of that. So that's what you get with the volatility. And the thing I say to people all the time about that is just honestly just look at the stock prices less often. I'm not joking about that. You will believe that there's more volatility if you check the stock price a couple times a day than if you check it just at the end of every week.
Sure. Yeah.
And honestly, the volatility doesn't matter. All that matters for you to decide if you want to buy or sell the stock is the actual price. So it's very important that you know the price of everything. It's not very important that you know if it's gone up or down. That's the part that really does not matter that much. And I think people get confused about that. They know, I'm a value investor. I need to know the price of everything. Yes, you need to know the price, but you don't need to see this red or green arrow. That part's not important.
Yeah, there's been a couple of times I've messaged you saying like, hey, XYZ stock is up. Right. Have you checked? And you're like, no, you said something like, you haven't checked it because it hasn't closed yet or something like that.
Probably something like that, yeah.
I think one thing that's kind of, and I think a lot of people, if they want to sort of help guard against that, when you talk about like over a 10-year period, is one thing that we do is, and I learned this from you, is see what the stock has done forever.
Yes.
Right? So you do like, okay, what is the stock what is it returned since it's been public? What did it do the past 15 years, 10 years? And that kind of just helps, in my opinion, think of it working, geometrically over time.
Absolutely, yeah. And that's like, I think people, it's not like, for instance, it's not at all the case that I like to see a stock trading at a low when I'm going to buy it or something. That's not, I liked, usually the kind of companies that I want to buy have had very good 15-year stock records, almost always. And they've certainly had great records since they've gone public. They're not necessarily things that are at 5-year lows and stuff like that. The other thing that I've noticed, so with the volatility stuff, the other thing that I notice a lot, which is kind of interesting, is I've realized compared to other value investors I've talked to, that I sell my losers more than they do.
So like you get out of them or what?
Yeah.
Okay.
And I don't know why that is. I don't think that I'm doing it because they're performing badly as a stock.
Yeah.
But just because I don't like them as much as the thing I'm replacing them with. But the thing that I've noticed a couple times with people talking to me about it is I sell something and they're like, isn't that a couple percent below, the price you originally bought it or something? And I'm like, yeah, okay. It doesn't matter that's 1%. I have 2 stocks that I know well from like seeing what they were down or whatever that were down less than 1%. And I can tell you from talking to people, most people will never sell a stock where they have like a 1% loss in it. Unless it has to get to that even point. It has to turn green before they'll sell it. Yeah. And this is what I mean about the volatility thing. It does not, the price is very important, but that's still a 1% price difference. That's all that it is. The fact that you bought it at that one particular price just becomes an obsession for them about, deciding whether this was a success or a failure, when really it's still just a 1% difference. And there's nothing wrong with selling a stock for a 1% loss or something, or for a 10% loss if you found something that's better to put it into.
Sure.
Selling because the stock went down is a dumb idea, but not selling because it hasn't gotten back to the price that you bought it at is also a really dumb idea. And yet with value investors, I see that a lot, the second one there, where they do not like to sell things that are down from the point they originally bought it.
So the way that we place bids, have you always done it like that? And could that be good for people to, and the way that we do is we typically just put limits in, good to cancel orders. We let the volatility, I guess, kind of come to us, if you will, in a lot of cases.
Correct.
We're very patient when getting in companies.
Yeah. So for those who don't know, like the difference between kind of illiquid stocks, if you're listening to this podcast, you probably know more about illiquid stocks than most people. But like if you go to buy Microsoft, generally you're just putting in a market order to say buy now, and that's like very close to what happens, and it gets executed right away. What we're generally doing is we're bidding to buy a stock at some price which is lower than, often lower than last trade, but certainly lower than the ask, than someone wants to be paid for it. And then you're waiting and to see what happens. And sometimes they will end up with the price coming down to you right away, and sometimes it'll be a long time.
Do you think that's market makers filling it, or is it other individuals that see it, or what?
Yeah, so I mean, I can tell you kind of for us, because there's some data on that. Overwhelmingly, it's market makers when it's small amounts. Yeah. No. But I mean, some of the things we got filled, no, I know that they're not mostly market makers. We got filled with too much. Market makers are not willing. I mean, in OTC stocks and stuff, it can be different in other places. Market makers aren't interested in selling you 9,000 shares at $100 each.
Sure.
What they're interested in is $100 of a $9 stock. That's what they love to do. They love to deal in small amounts over and over again
because the transaction.
Yeah. They don't want risks of carrying a lot of inventory one way. Yeah. So no, and that happens a lot when we want very, very liquid stocks. What you need to do is you need to get a person who's not a market maker to sell you that stock. It's usually in illiquid stocks very easy to get someone to sell you 100 shares or something. But what you'll realize is as soon as you buy that 100 shares, they're not going to give you those 100 shares at that same price again. The market maker is not going to keep doing that. So very quickly you have to find someone who isn't a market maker who wants to sell you stock. Just in general, you're not going to get filled by a market maker that way. But for people listening to this, if you want 100 shares of, if you want $1,000, $2,000 position or something, yes, it's going to be a market maker probably that's going to do it. Yeah, I mean, almost certainly.
What else do you think? So, I mean, limit orders, seeing how the stock performs well over time. What else do you say? Like, I guess good to cancel orders where you put it, you let the volatility come to you.
That's one way we should think about it is that when we make a decision to buy a stock, often, I mean, it can be a little different depending on our situation, but I would say a pretty good kind of general example of what we do is we would put in a bid and then we wouldn't change that bid till next week, basically. So
we look at it once a week.
Yeah. So like during that week, what might happen is the price might come down and we might get our shares. If not, then yes, the stock could run away from you during that 1 week. For illiquid stocks, it makes sense to do that because you don't want to kind of by your own bidding cause the stock to move in a direction, and so you don't want to do that. But it is logical for people listening to this that you don't want to also be like, okay, I'm going to buy the stock. Oh, it went up. Okay, I'm going to pay more for the stock now. You want to always have in mind a price that you have, and I mean, I don't really think in terms of the price. I think in terms of the return I expect from it, which is based on the price. So if the stock goes up 20%, you don't want to still be going, okay, well, I'll buy it now at the higher price that way. But it's interesting. What I find more from people is they have a price they want to buy it at when it goes down. Well, with investors, a lot of times I see with great companies, they always want to buy it 15 to 20% less than where it is. And it doesn't. And when it gets down 15 to 20%, they still want to buy it at 15 to 20%.
Yeah, they were. I'm just gonna wait for it to. I'm gonna see how much lower it can go. Sure.
And when it actually starts happening, there's some sort of reason. Now, it's usually just news stories and whatever, but now that's gotten them to adjust their estimate. And there's too much adjusting of estimates that way. So, like, you think it's worth, you thought that this restaurant was worth $100 a share. Then it comes out with same-store sales that are down 1%, and now you think it might be worth $80 a share. Unless you really misjudged it in the first place, you shouldn't be doing that. Your estimate for it shouldn't be varying a lot. Now, for me, for some companies, that would be the case. But not for anything that we would buy for the managed accounts. Those are all things where there's not much news that can come out that drastically changes my opinion of it. That shouldn't be happening, because you want to be looking at things that are more predictable and stuff, like the sorts of things that Buffett would buy or something like that. Things where they're commodity businesses and things, that would be a lot tougher. But for something that has a more predictable sort of past, and that's the other thing to look at is, like, I always like to look at as many past years of earnings as possible, 20 years, things like that, and see it charted out for me, or at least see it just by running your eyes over it to look at just...
Because you just want to make sure the stock works out over time. The business where, I mean, there's a company that we own that's paid out a dividend, or it's been profitable, or net income has grown by how long? I mean, 20 years in a row or something crazy something like that. And it's paid out dividends 20 years in a row. I mean, over time the stock works out.
Dividends 40.
Yeah, longer than that. Yeah, I meant 20 years of,
Yeah, it's 20 years of, like, EPS gains or whatever, basically. And there are some companies like that. They're more likely in financial type things and subscription type things and stuff like that. But it's important that to understand how volatile the stock is, because, like, what you're talking about there, for example, it's rare for earnings to change by more than 5 to 10% a year, right?
Yes.
Right. And going back 20, 25 years, it's rarely changed by more than 5 to 10% a year. However, we have so many examples where the stock has moved by way more than 5 to 10% a year. There are examples where it's moved 50% in 6 months. So you really have to think about that for a second. Something that doesn't change in earnings more than 5 to 10% a year for 20 years, for some reason has periods where the price changes 50% in 6 months. And not one period. That's happened more than once. So, that's what we mean by volatility. Like, what sense does that really make?
No, I mean, I don't know. How do you think about volatility if you're fully invested? Because obviously we have some cash. I mean,
that's true. We have some cash.
We have some cash, but I mean, you probably think about volatility a little bit differently when you're fully invested.
Sure.
And I guess that's where a lot of people get scared, probably.
Yeah. And that is one thing where people sometimes talk about, like, why aren't we fully invested?
Yeah.
When things are going well, people are always asking, why aren't you fully invested? Because, but seriously, people say a lot to me, like, okay, well, why would you hold cash instead of Berkshire Hathaway or the S&P 500 or something? Yeah. The reason for doing that is, and this is sort of the reason for owning illiquid things too. The problem is not really that you can't sell something. Liquidity is going to let you get out of the stock, but it's not going to let you get out the price you want. So, in 2008 or whatever, everything was dropping by a lot.
Yeah.
And so it was very liquid. You could get out. Small investors never had any problems getting out of any of the stocks that they were in. But at the end of the month, it could be 10% less than what you had been hoping it was going to be at the beginning. And that will happen even to Berkshire Hathaway. And so, the reason, it's a complicated thing, because if you look at the entire time, I can look at the entire time I've been investing personally and stuff like that and see that on average, definitely I would have done better being 100% invested, because sometimes I've been more in cash than I am now. It's never an objective to be in cash. But I think I've said this before, which is that if I don't see something that has a, to me, clear path, which is pretty usually clear, sort of conservatively calculated path to 10% annual returns over the long term, I'm not going to buy it. And so sometimes that happens. That's happened lately. I think in the managed accounts we probably averaged 20% cash over time. We've only been operating for about a year, but maybe a little lower than that.
I would say a little lower than that.
Okay, a little
16 lower. Probably right. Yeah, in that area.
Yeah.
Between 16 and 20%. Yeah.
Yeah, and it's frustrating because if you look at our quarters, for instance, I can see that if we had been not in cash at all, then we would have outperformed in cases where we performed in line.
Yeah.
And I'm sure that, if you're looking quarter to quarter, that matters, where you're like, oh, we would have beaten the S&P by a couple percent if we were 100% in cash, and instead we didn't, That probably upsets some people when they realize that, their stocks outperformed the S&P.
Yeah, sure.
But because they weren't 100% in their stocks, they didn't. But, the thing with the volatility with cash is that it's almost going to work the opposite of what you think you should do. So
what do you mean by that?
Well, when people are like cash is king and everything, that's when it's not.
Yeah, sure.
That's when you need to be spending it like crazy. And when people are saying, why haven't you been 100% invested in things, that's when it might be useful.
What do you think about when people say you never go broke taking a profit?
Yeah,
I hate that. That's such like a broker saying, isn't it?
I'm not a big fan of that one. I'm also not a big fan of like you sell half the position after it's doubled and now the rest is free money. Or whatever.
House money. Just let it ride or something like that.
I'm not as big a fan of that one. No, I mean, I think I'm pretty. I mean, last year we sold a position that I just sold, and it wasn't a big performer or anything. And I'm sure people were like, "Why'd you do that?"
Yeah.
But I'm not afraid to sell things that are pretty flat or down or whatever from what we've had recently. It's looking at the company and the price, and
there was other stuff that you like better. I mean, the way you weight them in your head.
Do it. Yeah, is to weight
you just have another idea that you like more. Yeah.
Yeah.
Or feel more. You feel safer or whatever.
Yeah, but it comes down to the asset. A lot of cases. I mean, we're willing to hold a business that I really like a lot. A business that I think earnings will be up almost every year for the foreseeable future. And there's some like that. So when you see a business and your best guess is that in almost all the next 15 years, earnings will be a bit higher than they were the year before. Earnings per share. Mm-hmm. That kind of business, I'm a lot less likely to sell, you'll notice, even if it goes up in price and stuff. Then it's something that's more of like an asset play or very cyclical or those things have a tendency to get sold pretty quickly. And that's just because of, you can go too far with that. Buffett held Coke when he knew that was too expensive.
And he's even talked about that. He probably should have sold it, right?
And that was a mistake. Yeah. Mm-hmm. But... And it is a mistake to do that, and certainly we don't hold things that long, and we certainly don't hold nothing that we own has ever gotten to a price like Coke got in the end of the 90s. Mm-hmm. Very few stocks get to those kind of prices, but I mean, I think that a volatility is in part a big advantage of it is the ability to sell out your lowest quality businesses and buy higher quality ones. That's what I always like to do. And so like when I think back to 2008 to the end of 2008 to the beginning of 2009, well, really the first 6 months of 2009 especially, I just upgraded to just the best businesses that I've probably ever owned as a group in the portfolio. And that's just because they were so cheap. Whereas normally I don't get the chance because I'm a value investor or whatever. I'm not willing to pay 20 to 40 times earnings or something. I want to pay 10. Mm-hmm. And so suddenly there was a bunch of businesses available at 10 that were the very best that, I could imagine.
It's kind of like, you wrote a blog post about have any of your sell decisions when you've when you've sold stock just to simply raise cash.
Right. They haven't added value.
Because you, not because you had another idea or whatever, like an opportunity cost speaking wise, they didn't add anything to your performance.
Yeah. Nope. They hurt performance. But in all those cases, those were good businesses. Or shouldn't say they were good businesses as much as I should say I turned out to be right about the businesses long term. Yeah. None of this works unless what we're really saying is like you don't want to sell something to raise cash if you think you're right about the business over the next 10 years. Mm-hmm. And that's what we're talking about. If you notice, like in the portfolio that I run, if you see that I'm not selling some stuff, regardless of it getting a bit higher in price and things like that, that probably means that I think that I'm still right about the 10-year future of the business. Mm-hmm. And if you see me selling it, I'm a lot less certain about the 10-year future.
Sure.
And that's what kind of happens a lot that way. And so when you're talking about do my sell decisions add value, no, they didn't if I was right about the business. Now, sell decisions, sometimes taking losses even with sell decision did add value.
Sure.
I can think of a few. I sold Barnes & Noble, added value. That stock went down quite a bit after I sold it. I kept the BWX Technologies part of Babcock & Wilcox, sold the part that went down to basically zero.
Yeah.
So that kind of sell is a good decision. Sure. So selling to avoid you were really wrong about part of, in that case, part of the business or whatever, but you were really wrong about something about the business. Selling to correct a business error that way is a really good thing. But selling because something went up in price that you were really right about the business.
Not because you like another idea or something.
Yeah. To raise cash is not a good idea. Now, because you like another business is a different story. If you find something better, which is what generally is what you want to have all your sell decisions be. You would love them to all be selling something you like to buy something that you love. Mm-hmm. Yeah.
What about selling because you don't like where the current market is?
Well, I don't do that.
Yeah, I know the answer to all these questions. I'm just thinking of stuff that people may be thinking,
Yeah, and I've said before, I think we know even going back a year and a half or whatever when I talked about it, I've said that I thought the market was expensive.
Yeah.
And so from the perspective of like timing the market or whatever, shouldn't I be in some huge amount of cash? I'm pretty sure we've never, since we started the account's been over 20%, right? Like there's never been a day where we're over 20% cash. No. Okay.
Unless it's obviously a new account, but an actual model portfolio,
no. So there you go. So the entire time we've been doing the managed accounts, I thought the market was very overpriced, and I've never had more than 20% in cash. So you can see that's not a market timing thing. That's not how I think about it. And I think it's a good idea for you not to think about it that way either, to have an opinion. If you want to have an opinion on the market, that's fine. When I say the market's overpriced, I think generally I mean it's just really hard to find anything. That's like what Buffett and Munger were talking about, where they said the price they'd have to pay to take over a whole business is incredibly high and stuff. That's all I mean, is that all the kind of great companies on my watch list, my wish list, whatever you want to call it, are too expensive for me to buy. That's what I mean when I say the market's expensive.
Got it. So if you had to give the listeners a few takeaways on volatility and how to use it as your advantage, what would you say?
Okay. My number one suggestion would be check stock prices less often. That would definitely be number one.
Okay.
My number two suggestion would be to use volatility to upgrade the quality of the businesses that you own.
Okay.
And my number three, okay, would be to don't be afraid to sell something that you have a paper loss, an unrealized loss on, that would make this a realized loss. That doesn't mean anything. The opportunity cost or an actual realized loss are not any different.
Yeah.
So don't be afraid to do that. What were your suggestions?
And then I would say at number 4, build a watch list. That's the most. That's the most important thing you do, though.
That's true.
I mean, you do. That's what you do.
That's all that. Well, most of the time, all I'm doing is a watch list because we're not changing what we own that much all the time.
Yes. So build a watch list of where you could be able to act decisively if there
the
is
businesses
volatility.
You know well and like, and buy those when there's price volatility. Yep.
I agree. Awesome. Well, I thought that was a great podcast. I want to thank everybody so much for tuning in with us. If you do like what we are doing here and you want to support us, feel free to give us a rating and review on the iTunes podcast app. That helps us out a lot. If you want to join Focus Compounding, go to focuscompounding.com. Not only will you see a place to enter in your email for a free 1,000 plus word, but typically 1,000, write up every single month or every single week,
Stock write up, yeah.
Stock write up. But if you do want to sign up for the premium membership, use the podcast promo code and that'll take some money off of your subscription price every single month. I want to thank everybody so much for tuning in with us. Thank you so much for all the support, ratings, and reviews. That means a lot to Geoff and myself, and we'll see you in the next podcast.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.